So you're thinking about buying a home. Awesome, but you probably heard these two terms thrown around all the time: conventional and FHA, kind of like the two main highways to owning a house. But figuring out which one to take, yeah, that can kind of confusing fast. So today we're going to break it all down and help you figure out which path is the right one for you. So let's just dive right in. This isn't the big question is which one, and honestly the right answer is it's all about you, your credit, and how much you've saved up and what you're trying to do. But by the time we're done here, I promise you're going to have a way clearer idea of which lane you should be driving on. All right, here's our game plan. First, we're going to meet our two main loan types. We'll dig into the big stuff that everyone asks about: down payments and credit scores. And yep, that dreaded mortgage insurance. We'll even cover a few key rules, and then we'll pull it all together so you can make a really smart choice. Ready? Let's do this. The first things first. Let's get to know our two contenders. Now, it might sound a little basic, but the real key to understanding everything, and I mean everything, is knowing who is backing each of these loans. And that's where all the differences come from. So, in one corner, we've got FHA loans. These are backed by the government, the Federal Housing Administration, and they're really designed to make buying a home easier for more people. You can think of them as a flexible, friendly option. And in the other corner, you got conventional loans. These are the private market champs backed by Fannie Mae and Freddie Mac. They tend to reward folks who have stronger credit and a little more cash in the bank. Now, for the number one question on pretty much every single homebuyer's mind is the down payment. Let's be real. How much cash do you actually need for an FHA loan? The magic number is often as low as 3.5%. And it's one of the biggest selling points. It's a lower hurdle to clear. And if you haven't saved up a ton of money, and hold on, that's not the whole story, because get this: conventional loans actually go even lower, just 3% down. And the fact surprises a lot of people. It also leads us straight into busting one of the biggest myths of all of real estate. Let's just get this out of the way right now. The idea that you absolutely need 20% down for conventional loans is a total myth. Now, putting 20% down is great because it helps you avoid mortgage insurance, and we'll get into that in a minute, but it's absolutely not required to get the loan in the first place, okay? So, moving on to credit scores. Does it matter? Oh, you better believe it does. About how much matters completely for these two loans is a really important distinction. And the difference here is, well, it's night and day. FHA loans are way more forgiving. The lower score doesn't automatically ding you with a higher interest rate or more expensive insurance. Conventional loans are a totally different story. They're extremely score sensitive, and that three-digit number is a huge deal, and it directly affects both your interest rate and how much you'll pay for mortgage insurance. So here are the general rules of thumb. Conventional loans, they're typically looking for a score of at least 620. FHA, on the other hand, can go all the way down to 580. But, and this is a big but, lenders can and often do add their own extra rules on top of these guidelines. They call them overlays. So if one lender might be fine with 620, another might be at 640. So you got to remember the score is just one part of the story. Lenders are looking at your entire credit profile. So have you had any late payments or major hiccups? FHA is usually more understanding of those. Life happens moments, but really for both loan types, they really want to see the whole picture, not just the number, okay? Deep breath. Let's tackle the trickiest part of this whole thing. Mortgage insurance is an extra cost. That shows up in your monthly payment. And how this works is honestly one of the biggest, most important differences between conventional and an FHA loan. So first off, what is it even? To simply put it, mortgage insurance, or PMI, is to protect the lender, not you. See, if you put less than 20% down, the lender sees you as a bit of a higher risk. So it's basically the insurance policy they take out against that risk. And guess who pays that bill? You do. FHA mortgage insurance is in two parts. First, there's the big upfront premium of 1.75% of your loan amount, and it just gets rolled right into the total loan you're borrowing. Then you also have to pay an annual premium, which gets broken down into 12 chunks and added to your monthly payment. Now, conventional mortgage insurance, which is called PMI, is way more flexible. You often get a choice to pay it monthly, roll it into the loan, or even just pay it off in one lump sum. But the single biggest difference is the one thing you absolutely have to remember: that it doesn't have to stick around forever. Right. Listen up because this is a really big deal. With an FHA loan, you put down less than 10%, that monthly mortgage insurance payment is with you for the entire life of the loan, 30 years. But the only way to get rid of it is to sell the house or refinance into a different loan. But this is a game changer. With a conventional loan, the PMI automatically cancels. It just goes away on its own once your loan balance drops to 78% or what that home was originally worth. It's a massive difference for you and your wallet over the long haul. All right, so we've covered the big three: down payment, credit, and mortgage insurance. But there are a few other rules and limits you should definitely know about. Let's run through them really quick. Here are the two biggest ones first. What kind of property are you buying? FHA loans are only for a home that you're actually going to live in as your primary residence. Conventional loans are much more flexible. You can use them for your main home, vacation getaway, or even an investment property. Second, loan limits. Generally speaking, conventional loans, they let you borrow more money than FHA loans do, which can be a huge factor in more expensive areas. Here's another key difference. How much help can you get from the seller? We're talking about seller concessions. And that's just a fancy term for when the seller agrees to pay for some of your closing costs, which means you bring less cash to the table. With an FHA loan, the seller can chip in up to 6% of the home's price. But with a conventional loan, especially with a small down payment, that limit is usually lower, like 3%. Okay, we've covered a lot of ground. So now let's bring it all home and figure out which of these loan types might be the absolute best fit for you in your situation. Think of it as your ultimate cheat sheet. So, look, if your credit score is maybe a little bruised, or you just had some of those life moments, and the flexibility and forgiveness of an FHA loan might be your best bet. But if you got a really strong credit score, a conventional loan is often the long term winner, especially because that mortgage insurance eventually disappears, saving you a ton of money. It really comes down to which of these columns sounds more like you. So there you have it, the real deal. Differences between FHA and conventional loans. You're officially no longer in the dark. The power is now in your hands. And you know what? The next step isn't about having all the answers, it's about knowing the right questions to ask. So, what will you ask your lender? Make sure you get the absolute best deal for you.